A headline claims the Vegas casino CEO admitted he was losing $3 million daily. But the real story behind that viral number reveals no such quote, just a staggering $285 million quarterly loss, driven not by Vegas chaos, but by a single strategic move in New York. If the Strip isn't burning through millions each day, what is really going on inside America's most famous casinos? Viral claim. The claim that we are losing $2 million daily swept across social media and finance headlines. MGM's official filings for the third quarter of 2025 show a GAAP net loss of approximately $285 million. Spread over the 92 days in the quarter, that equals about $3.1 million per day, significantly more than the viral $2 million figure. Real math. This figure is not a direct admission from Chief Executive Officer Bill Hornbuckle or any MGM executive. Instead, it is a shorthand calculation repeated by commentators and amplified by traders and influencers online. Posts on Twitter, Reddit, and TikTok use the daily average to dramatize the loss, but the company's investor call and press materials never included such a quote. The real number, $3.1 million per day, comes from dividing the quarterly loss by the number of days in the period. It is a mathematical average, not a reflection of cash flowing out of the business each day. Major outlets such as CNBC and Yahoo Finance picked up the meme, but the company's investor call and press materials never described operations in those terms. The phrase became a viral talking point, but it oversimplifies a complex financial picture and leaves out the real reasons behind MGM's reported loss. The next step is to look at what actually caused the quarter's headline loss and why the day-to-day business in Las Vegas was not the main culprit. MGM's third quarter loss was not the result of daily operations unraveling on the Las Vegas Strip, but was triggered by a single high-stakes decision in New York. In late 2025, MGM's board and executive team withdrew from the race for a commercial casino license at Empire City in Yonkers. This move forced MGM to recognize $256 million of goodwill impairment, an accounting charge reflecting the diminished future value of the property after regulators shortened the expected license term from 30 years to 15 years. Alongside this, MGM wrote off about $93 million in capitalized costs tied to the abandoned expansion, including development expenses and earlier investments. These charges were recorded in the third quarter 2025 financial results and were required under U.S. accounting rules once management determined the project no longer justified further investment. The anticipated $2.3 billion transformation of Empire City, a plan that once promised over 1,000 new jobs and a Las Vegas-style resort in the New York metro area, was abruptly shelved. MGM's public filings and analyst notes confirmed the impairment, and write-offs accounted for the bulk of the $285 million GAAP net loss in the quarter. Yet even as these one-time charges dominated the headlines, the company reported total quarterly revenue of about $4.25 billion, underscoring the continued strength of its core operations despite the setback in New York. Accounting for a casino giant like MGM means separating headline-making losses from the actual health of the business. The $285 million net loss reported under GAAP for the third quarter of 2025 is a product of strict accounting rules, not a sign that cash is vanishing from the vaults each day. An accounting expert familiar with hospitality finance says non-cash charges like the $256 million goodwill impairment and $93 million in write-offs tied to the Empire City withdrawal are required to be recognized in the quarter they are triggered, even when no cash changes hands. These items reduce the value of assets on the balance sheet and create a large loss on paper, but they do not impact the day-to-day flow of money through MGM's operations. That is why investors and analysts focus on adjusted profitability measures. For the same quarter, MGM reported adjusted EBITDA of $506 million. This figure strips out one-time events, non-cash charges, and other accounting adjustments to give a clearer picture of ongoing earning power. Adjusted EBITDA reflects the cash-generating ability of the company's core operations, hotels, casinos, and entertainment, without the noise of accounting write-downs. In the words of one Big Four audit partner, GAAP net loss tells you what happened on paper, but adjusted EBITDA tells you how much cash the business is actually making. For MGM, the distinction is crucial. The company's underlying business remained profitable, even as accounting rules forced a headline loss. This context is essential for understanding the difference between a viral meme and financial reality. Las Vegas was the heartbeat of MGM's business, and it faced a challenging third quarter. Net revenue on the Strip dropped about 7% year over year, sliding to $2 billion. The decline went deeper on the earnings line, with segment-adjusted EBITDA falling 18% to $601 million. Behind these numbers were a mix of operational hurdles. The ongoing room remodel at MGM Grand reduced available inventory and disrupted bookings, while guests spent less at the tables and in restaurants. Food and beverage revenue, usually a steady pillar, softened further as visitors recalibrated their spending habits. Price corrected was the phrase management used to describe the reaction to summer pricing. Travelers arriving during the summer encountered higher room rates and resort fees, a trend that drew vocal pushback on social media and travel forums. Many longtime Vegas visitors compared the experience to old Vegas, where value deals and generous comps once defined the city's allure. The frustration reached a point where CEO Bill Hornbuckle publicly acknowledged the misstep and said MGM needed to price correct after the summer backlash. That meant rolling back some of the most aggressive rate hikes and introducing more targeted offers to win back hesitant guests. Midweek rates eased, and comp offers became more visible during off-peak periods. The impact was immediate. For travelers, this adjustment signaled a partial return to value, at least when the city was not hosting blockbuster events like Formula One or the Super Bowl. Recalibration is the operating word, the operational data, and Hornbuckle's remarks point to a company listening to customers, recalibrating prices, and trying to balance profitability with the nostalgia that keeps visitors coming back to Las Vegas. Caesars Entertainment, MGM's closest peer on the Strip, also posted disappointing results for the quarter, reinforcing that the softness was not unique to one operator. Caesars reported a drop in earnings that analysts attributed to similar pressures: lower gaming hold, higher costs, and fewer big spenders at the tables. While Las Vegas struggled, MGM's international operations told a different story. In Macau, MGM China delivered a 17% year-over-year surge in revenue, reaching $1.1 billion, and set a new record for quarterly EBITDA. VIP gaming turnover at MGM Cotai jumped by 44%, reflecting a robust recovery in Asian gaming demand. This geographic split highlights how MGM's global footprint helped offset domestic headwinds, providing a buffer that pure-play Las Vegas operators lacked during the quarter. Why? MGM's stock dropped sharply in after-hours trading, falling more than 7% within hours of the earnings release. The market's reaction reflected concern over the headline loss. Analysts quickly turned their attention to signs of recovery on the horizon. The upcoming convention season is expected to boost occupancy and stabilize rates, especially as the MGM Grand remodel wraps up. Company executives pointed to BetMGM's continued growth, with digital operations on track to deliver over $100 million in distributions for the fourth quarter. For investors watching closely, these factors, group business returning, completed renovations, and digital momentum, are being tracked as key signals for a potential rebound in both revenue and sentiment as the year closes. Viral claim: MGM's third quarter of 2025. GAAP net loss reached $285 million, averaging approximately $3.1 million per day, a figure that outpaces the viral $2 million daily claim. The headline loss was driven largely by a $256 million goodwill impairment and $93 million in write-offs following MGM's withdrawal from the Empire City Casino bid in New York. There is no record of MGM's chief executive officer stating the company was losing a specific daily amount. The number circulated on social media is a simplified calculation, not an operational confession. Las Vegas was softer in the quarter. Strip revenue fell 7%, and segment EBITDA declined 18%. Operational factors included the MGM Grand Room remodel, lower table games hold, and softer food and beverage performance. Macau bolstered the overall results. Despite Las Vegas' softness, MGM's overall revenue rose 1.6% year-over-year. Questions remain about how pricing strategies and guest expectations will evolve as convention traffic returns and market conditions shift. What is clear from the evidence, while headlines focus on dramatic losses, is that MGM's financial story is more about strategic decisions, accounting realities, and the ongoing recalibration of Las Vegas itself.